Okay, let's go ahead and do an example of a consolidation at date of acquisition for a wholly owned subsidiary. Again, this is going to be the simplest possible example, a wholly owned subsidiary, consolidation at date of acquisition, which means no income statement or statement of retained earnings to worry about. Let's go ahead and start with a real simple example. Assume that on January 1st, 2001, big company buys 100% of little company's outstanding common stock for $400,000. On that date, Little had a book value of $250,000, and Little's assets and liabilities had fair values equal to their book values, except for inventory, undervalued by $10,000, land, overvalued by $20,000, and property, plant, and equipment net, undervalued by $100,000, and let's assume that has a 10-year life. So the first thing we have to do is our cost versus book value equals differential analysis. So in this case, cost $400,000 less the $250,000 book value equals the $150,000 differential. And again, that essentially represents the amount by which we overpaid in an accounting sense for the acquisition. Now, of the $150,000 overpayment, $10,000 of that is explained away by the undervalued inventory. Again, if inventory is undervalued, that means it's worth more than book value, which means we're willing to pay more than book value. So one of the reasons we paid more than book value was because they had this additional inventory value. So that explains away part of the $150,000. In contrast, the land is overvalued, so we're going to need to add that one. And then finally, property, plant, and equipment net is undervalued by $100,000, so we're going to subtract that one as well. And what we're left with is goodwill of $60,000. Again, the differential of $150,000 minus $10,000 plus $20,000 minus $100,000, whatever we're left with is the goodwill. Now let's go ahead and prepare the consolidation at date of acquisition. And again, this means we're only combining balance sheet accounts. Our elimination entry is going to first eliminate the subsidiary's beginning of year equity accounts, and second, it has to revalue the assets up or down to fair value. Now let's go ahead and assume that Little's book value of $250,000 is comprised of common stock of $20,000, paid in capital in excess of par of $80,000, and retained earnings of $150,000. I picked those numbers at random, the only constraint being they had to add up to $250,000. So our elimination entry, we're going to go ahead and debit those beginning of period equity accounts, common stock, paid in capital in excess of par, and retained earnings for their book values. Next, we need to go ahead and adjust the assets up or down to reflect their fair value. Again, the inventory was undervalued by $10,000, so we're going to add $10,000 to inventory. Likewise, the property, plant, and equipment is undervalued by $100,000, so we're going to go ahead and add $100,000 to property, plant, and equipment. We have to go ahead and create the goodwill of $60,000. On the credit side, land is overvalued, so we need to reduce the land account with a $20,000 credit. And finally, all of that stuff combined closes out against our investment in Little account of $400,000, our acquisition cost. Okay, let's go ahead and post this stuff to our worksheet. Again, the worksheet is nothing more than the trial balances of Big and Little organized into a useful structure. Again, normally you think of a trial balance with a debit column and a credit column. Now we have a single column for Big Company, and we've taken the debit and credit accounts and just organized them into a balance sheet format. First the assets, then the liabilities and equity. Likewise for Little. All of these numbers are completely random, with the exception of the Little's owner's equity accounts and Big's investment in Little account. Other than that, the only limitation is the debit side equal credits, obviously. So we take the information from our elimination entry, and we post the debits to the debit column and the credits to the credit column. Again, simply transcribing from journal entry format to the column format of our worksheet. Once we do this, we simply add across each row, keeping in mind the debit and credit rules for our assets, liabilities, and equity. So in the case of cash and accounts receivable, as reported, Big had $30,000, Little had $20,000. There were no adjustments in the debit or credit columns, so the consolidated or combined total is $50,000. Inventory, Big had $50,000, Little had $40,000, but then in our elimination entry we added $10,000 to inventory because Little's inventory is worth $10,000 more than book value. So $50,000 plus $40,000 plus a $10,000 debit adds up to $100,000. The investment in Little account, it's on Big's balance sheet with a balance of $400,000, which is obviously a debit balance because it's an asset investment in Little. The corresponding credit of $400,000 eliminates that and takes the consolidated total to zero, as it must be. Property, plant, equipment net, as reported, Big has $300,000, Little has $200,000, and we added in the debit column another $100,000, taking the total up to $600,000. For For the land account, as reported, is $100,000 for big, $40,000 for little. And again, in that case, in the case of land, it was overvalued, so we credited or reduced the land account by $20,000, giving us a net consolidated total of $120,000. $100,000 plus $40,000 less $20,000. Finally, the goodwill doesn't exist on Big's balance sheet. It doesn't exist on Little's balance sheet. It gets created solely for the worksheet, solely for the consolidated balance sheet. So we put a $60,000 debit to goodwill on the balance sheet. Our accounts payable and bonds payable, there were no adjustments, so we simply add across. $100,000 plus $10,000 is $110,000 for the accounts payable. For the bonds payable, $200,000 plus $40,000 is $240,000. For the three equity accounts, what we see is that we've eliminated with debits the credit balances that Little had in their equity accounts. So what we're left with is Big's common stock balance of $50,000, Big's paid-in capital in excess of par of $130,000, and Big's retained earnings of $400,000.